See, I didn't hit the gym yesterday, but
Hi.
morning.
Okay, so I have tried starting. I've tried.
Does that help? Oh.
I see two of us.
Can you hear me?
Can you hear me?
Yes,
Is there an echo?
not anymore.
Sorry.
Oh, now there's an echo back.
This computer is giving me. It's just. Sorry. So I have to turn this one off, and then you won't be able to see me. Bye.
Oh, that's too bad. I want to see everybody.
Yeah, you guys turn your faces on, and we want to see you. Minus me.
Oh, now your echo's gone. We're good.
Hi, Sandy.
How are you?
I'm good. I'm so sorry. My gosh, I cannot figure out why. I cannot figure out why my camera will not work all of a sudden. It is so, I have troubleshooted, I have updated, I have turned off and on. So anyway, I'm stuck with this. Anyway. Okay, Jason. So you can't see me, but hi, Jason.
Hi.
Welcome. Thank you so much.
Oh, thank you for having me.
Yeah, so American Eagle Mortgage. You are a lender.
Yes, we are right up the street from you, about 2 blocks away. We're here for anything you guys need. We have kind of a long history with your office. Should be pretty well known in there. We've worked with Jeremy Kirk and Michelle Kovac and Chris Harwood for a long time. So we're here to support you guys in any way that we can.
Great. Yes, you guys do an awesome job. Why don't you go ahead and get started? Tell us a little bit about yourself and your experience, what you do at American Eagle, and then we'll just go right into, tell us about the mortgage process. We have agents on here. I can see Lauren, Sandy, Sherry, and Melanie right now, and this is recording, guys and girls. These 4 ladies with us right now are newer and brand new to the business. So take it away, Jason.
Excellent. So once again, I'm Jason Roth, American Eagle Mortgage, the Burris and Sparks team. Shane Burris and Dylan Sparks are our 2 main loan officers here that founded the team. Shane has over 23 to 25 years experience in the mortgage industry. Dylan's been on the team for the last 4 years, I believe, 5 years, and I've been here coming up on 3 years. Generally, I'm a licensed loan officer. I also am the marketing strategist for the team. So I kind of have a dual role where I can help out agents with any marketing needs to grow your business, and can also play the other side of it by being your loan officer contact. Before coming to the mortgage industry, I was in publishing and printing, so I do know a little bit about marketing, and I also know a little bit about the loan side of things. To start off, I wanted to kind of go over the loan process as far as kind of how things work. Starting off with a pre-approval, obviously you want your clients to be pre-approved so you're not wasting your time running around all weekend showing them houses that they don't qualify for. So that's where it starts with us. Getting your pre-approval, we qualify them, send them a copy of their pre-approval letter with the details and get a copy to you. From there, you guys can get out and start the hunt. One of the things I did want to touch on is generally there's 3 of us on the team. There's always somebody here to do a pre-approval for you. Generally, 24 hours a day, somebody's available. Sometimes though, not all pre-approvals are as easy as just a simple credit review and talking to the borrower and moving along. Sometimes they may take a day or 2 if there's self-employment income or they have multiple rental properties, or if it's a more complicated income structure than just they receive W-2 income and they receive a paycheck. So most of the time we're quick back to you. They're quick to get you ready. Occasionally it may take a little longer. So if there is a slight delay in figuring it out, it's just us doing our due diligence to make sure that you do receive a pre-approval that will go through funding. So after the pre-approval, agents are, you're out showing your clients houses. Next step, obviously, is going into contract. Once you have the contract written, comes to us, we contact the borrower and they make an official application. So that's where they fill out the complete application and start providing their documents that we use to send to underwriting. Once they've completed the official application, we order the appraisal, and that gets scheduled per the listing agent's time that fits with the seller. After that, once we get the appraisal back, or kind of at the same time, the loan is being processed. That's where our processor, we have in-house processing and in-house underwriting. So our processor is contacting the borrower, collecting documents, verifying their pay stubs, verifying their work history, putting the file together so we can get as clean of a file into the underwriter as possible. From there, once it leaves processing and is now officially in underwriting, at that point, it's on the schedule for the underwriter to review and make sure that we've given them the correct information and that it fits with the guidelines. This is where, at this point, generally is where you'll see or you'll hear that we say we have conditional approval. So that's basically the underwriter saying, hey, I approve of this. It generally fits all of our guidelines, pending something else. We need an extra month's bank statement, or we need another pay stub, or something that obviously doesn't affect you guys. But once we say we have conditional approval, we're getting into the right step. It is a moving forward loan. After the underwriting process, from conditional approval, our loan coordinator, Alicia Gummany, who's one, if you work with us, you will hear a lot of, she goes back and forth. She's kind of our liaison between underwriting and the final borrower, collecting the conditions that the underwriter establishes. So she's kind of running around between title and the borrower and the agents, and she's a pretty busy lady. But that's where she'll, get a hold of the client and the agent and say, hey, we've got clear to close. It's been approved. We've satisfied all the conditions. And then we schedule the closing and get you guys to the table and the client into the new home. So that's kind of the quick version of the process of kind of how things run. Any questions on that, on how pre-approvals are generated, or how the process generally goes?
Yeah, I forgot to mention, you guys feel free to ask questions whenever you want anything
Yep.
clarified.
Jump right in. If there's anything, if I'm going too fast, slow me down, or let me know if you have any questions.
I have a question.
Sure.
This is Lauren.
Hi, Lauren.
At what point do they get locked in with their interest rate?
So that is when they make the official application. During pre-approval, we kind of have, and that's in the next section that we'll go over, is kind of how we qualify people. But generally, we have an idea during pre-approval of kind of the range that they'll be in. You know, obviously there's daily fluctuations and the market kind of changes, but you know, we have an idea. But once they make the official application is the point that we lock the loan, and then the rate is locked through the closing date.
Okay, thank you.
You're welcome.
I also have a question.
Sure.
This is Sandy.
Hi, Sandy.
What I was wondering is, with the pre-approval and then going in after we're doing a contract and getting the conditional approval, does the agent have, are they able to get any information? Do they have to have a release from, you know, a signed document saying we can get information, like how the process is moving along?
Yes, there is. We do have a form that's within the official application that says basically you're allowing us to release information to involved parties. Obviously, there's some information that just you don't need to know because it just doesn't affect you. But as far as transaction information that involves the actual transaction, that is, you know, we'll give you guys updates on when the approvals or when the appraisal's been ordered, when it's back, you know, if there's anything we need your help with. A lot of times, you know, you're involved in it with us. So if we're not getting something from the borrower, you know, hey, Sandy, can you give them a call? And, you know, we're still missing this information and they're not responding to us. So it is a team all the way through closing. So the agents are involved pretty much through the whole process.
Thank you.
Hopefully that helps.
Thanks.
All right, so how we qualify individuals. So there's three main factors we look at when we're issuing the pre-approval, which is their income, their credit score, and their debt to income ratio. One of the big misconceptions is that we're approving somebody for a amount of home. What we're actually doing is approving them for a monthly payment that fits within their debt to income ratio. So that payment is obviously associated with the cost of the home, but that's what we're looking for, is how that payment fits into their overall debt to income structure. Income, obviously you need to have income. If you're self-employed, we need 2 years of self-employment to be able to use that income. If you just recently switched from being a W-2 employee to being a 1099 or self-employed, we need 2 years of that. That's a pretty hard and fast rule. So other than that, if you are a W-2 employee, we need 2 years of showing that, you know, you have stable income. From there, you have to have qualifying credit scores. So generally, 620 is going to be kind of the minimum that we can work with. We used to be able to go a little bit lower, but given the current COVID situation, they've kind of tightened up restrictions and what we need to do. We can get into that a little bit later, but 620 is the bare minimum. There are programs that we'll get into in a second that require higher minimum scores, but generally 620 is what we're going to need for a minimum. Debt to income ratio, so that's where we're looking to see how that payment fits in and what that's going to affect with them. Any questions on those three things? Good. Okay. So the types of mortgages that we offer, that we handle, there's generally two different types of mortgages. You have government-backed mortgages and then a straight conventional loan. Under the government-backed mortgages, the most common one will be an FHA loan. That starts with a minimum of 3.5% down, and is generally goes to lower scores. We can go down to 620 with to do an FHA loan. There is included in that a funding fee, and then there is lifetime mortgage insurance. So the trade-off is that it's government backed. We're allowed to use a little bit higher debt to income ratio, but you get the funding fee that is included into the loan, and then also the lifetime mortgage insurance. The other common type, at least around here, a little south of Columbus, we have USDA loans, which are government-backed rural development loans. Those are 0% down. Great option if you're looking out in the country. Generally has to be outside of a town of 10,000 people. So Asheville area, Mount Sterling, Commercial Point, kind of areas like that. Think of USDA RD loans. Those, though, come with a higher credit score requirement, generally 680 plus. There is a funding fee involved in that as well, and that does have lifetime mortgage insurance, not as much as the FHA loan, but it is there. So it's a great option if you've got somebody who's looking out into the country. They can definitely, if they qualify, they definitely can get a great deal of not having to have a down payment out there. The third most common type is going to be your VA loan. So that's government backed by the Veterans Administration.
Jason, can I ask you a question? I'm sorry.
No, just sure.
I'm sorry. Back to the USDA real quick. I know we've kind of went back and forth emailing about this in the past,
Yes.
but what is the income guidelines? Because don't you have to make a certain amount of money in order to qualify?
There are
money?
other guidelines to it. There are debt to income restrictions, basically. So it's not necessarily you have to make a certain amount of money. It has to fit into a certain debt to income ratio. That's more restrictive than your FHA loans. So USDA is a little tighter with that, and we kind of need to. It's a little more in depth than I think we kind of have time to go into here.
Okay. No, I meant like as far as like your annual income amount. Like I thought you could only make up to a certain amount in order to qualify.
That is true. There is a maximum. I get what you're saying. So there is a maximum, I believe, with a two-person family, you have to make less than $92,000 a year.
Okay. All right. Thank you. That's what I was wanting to know.
Okay. Yeah,
I couldn't remember that number.
Yeah. Okay.
Okay. Thank you. Sorry.
Yo, you're fine.
So if you are a two-person family and you make more than 92,000, you can't get a USDA loan?
You will not qualify for a USDA loan.
Got it. Okay.
So if you have, and it goes up from there, it's kind of graduated. If you are a three-person family, it goes up a little bit. I believe that's 111,000.
When you say three-person family, does that mean those like, so it's me, my husband, and my daughter? Are we a three-person family?
You are a three-person family. That is correct. And if you have two kids, it's a four-person family, and that goes up a little more from there too. So it is graduated. It maxes out, and I don't remember that. I apologize off the top of my head what the max is. But generally speaking, if it's going to be between $92,000 and $110,000 for most people. Got it? All right. So VA is 0% down. Obviously for veterans or current members of the military or National Guard or Reserves. National Guard and Reserves must have eligibility, certain amount of months deployed or years of service. Obviously that's on our end to figure out, but that comes with a variable funding fee and no mortgage insurance for the life of the loan. So that's basically the government giving back to the veterans. With any government-backed loan, this is kind of the big one and more of the ones that you guys will probably run across and will need to know. Anybody who has had a Chapter 7 or 11 bankruptcy is a minimum of 2 years for a government-backed loan. 1 year for a Chapter 13. If they are currently in a Chapter 13, we can look at it as long as they've been in it a year and have made payments for it, on-time payments for a year. USDA, you have to be 4 years removed from any bankruptcy discharge. So while USDA is a great, once again, a great option, it's more restrictive than FHA or VA. But those are the bankruptcy is kind of the big one that you guys will run across most often. Any questions on government-backed loans? Good. Okay. Conventional loans, regular conventional higher credit score loans start with a minimum of 3% down. I know everybody thinks that you have to have 20% down to go conventional. We could go down to 3%. Generally, most people go with the 5% down as the minimum. 3% requires a little higher credit score, but it can, still on the table. There is no funding fee. Government-backed loans require a inspection, kind of similar to a home inspection where they're looking for health and safety issues, peeling paint, no rails, cracked steps, things that can hurt the homeowner. They will come through similar to a home inspection and will require repairs in a government-backed loan. In a conventional loan, we don't have that inspection. So not saying that the home can be, a total garbage pile and get around it, but it doesn't have that inspection requirement. So if there are, some, maybe a set of steps missing or cracked or something like that, we can get around that since with convention. So there's no inspection restrictions. There is mortgage insurance on the loan until you get to the 20% equity threshold. At that point, mortgage insurance drops off. So versus government-backed, where it's there for the life of most loans, conventional, you only have that mortgage insurance until you hit 20%. Or if you started with 20% down, that's kind of where everybody feels that you have to have 20% down. If not, there's mortgage insurance until you get to that point. Max conforming amount for a conventional loan is $510,400. So that is, most loans are sold onto the secondary market to Fannie Mae or Freddie Mac, as you've heard of them. That's the limit that they will accept onto the secondary market. So that's conforming loan limits as of this year. Investment properties, we can do investment properties, requires 15% down and 6 months of liquid reserves for the payment that you're qualifying for. Any conventional loan is 4 years removed from a bankruptcy, from the discharge date. So can't do Chapter 13 while you're currently in Chapter 13, 7 and 11. All three of them have to be 4 years removed. Any questions on conventional? Good there? All right. One of the other options is down payment assistance. So there are programs we offer through the Ohio Housing Finance Association. There is down payment assistance available if you have generally a credit score above 660. You would qualify for a maximum of 5% down payment assistance. Down payment assistance allows us to wipe out, basically, we can, credit score requirements, we can go to 3% down and 5% assistance, which offsets some of your closing costs and ends up getting to a minimum amount out of pocket for the borrower. With a little lower credit score, we can go down to a different program that's FHA based that will offer up to 3.5% down payment assistance. So there are options if you have very little money to no money to get borrowers into their home. So any questions on down payment assistance? I know that's generally, and once again, that all goes back to the pre-approval of what, what they qualify for. I know obviously with the contract, it doesn't kind of matter to you guys if they're getting down payment assistance or not. But it's there, if you run across your borrowers who don't have a lot of reserves. Financeable housing types, single family residence, condos, PUDs, freestanding condos, manufactured housing, and mobile homes on land are all going to be financeable. With manufactured housing, it's basically considered a stick-built home as far as we're concerned. As far as with the ones that are assembled. Mobile homes or other types of manufactured housing, a double wide or something similar to that, must be on a permanent foundation, and the land must be owned. It must be transferred as real estate. It can't be in a mobile home park or something like that. That's kind of more of an auto loan. These are, we're looking for the land along with it. What is not financeable, once again, a single wide in a mobile home park, something like that, or just straight land. We do not do land loans. That's more of something for farm bank or, you know, something like that, where they're more interested in the land. We, you know, we're taking more of the risk on the home is what we're lending on, and the land is second. Somebody, you know, a farm bank or a local bank is generally looking to secure the land and don't really care if there's a home on it or not. So, costs involved in the loan, the three big ones: down payment. Obviously, you have to have a down payment. One of the questions we get a lot, or see fairly often, is somebody saying, well, I went into contract at $100,000, but the loan papers only says that, you know, I'm borrowing $96,500. Why is that different? Well, down payment. You know, that is the cost of the loan. That's the final loan amount is the purchase price minus down payment. Closing costs are included in the loan. Closing costs are your lender fee, which is including underwriting fee, document fee, those kind of in-house fees, your appraisal fee, and title fees. That's obviously up to the listing agent to pick the title company. So those are fees that we cannot do anything about. Those are the fees that they are what they are. The other thing that we're kind of getting here now that we're in this COVID time is loans are costing, lower credit score loans are having more points added to get to the rate. And this will kind of lead into the state of the industry now. As the credit markets have tightened up and forbearance has become an option to many borrowers, the secondary markets are trying to hedge their bets and make sure that they're not getting stuck with a loan that goes into forbearance immediately after it closes. As a consequence of that, rates are starting to charge points. So it's becoming more costlier to your lower credit score buyers to get a reasonable rate. And that's part of the reason I said earlier that we, you know, go down to a 620 minimum. I can tell you that currently, while it's possible, the borrower really wants to work to get their credit score up a little higher. It's generally not in their favor to buy at a 620. Definitely possible, definitely can get it done. Going to cost them more until we get out of this COVID situation. In exchange, either a higher rate than where general rates are, or it's going to cost them to get there. So two parts of going into what's currently happening. So as we have the increased cost to lower borrowers, there was a time earlier this year where the markets would not provide a rate to lower credit score borrowers. Back in March, early April, the minimum credit score was probably 660, and that's what it was going to be. Everybody else was locked out. We've gotten better on that as things have kind of opened up and markets have settled. As it's kind of getting tighter with the lower credit scores, if you are 660, 640 to 660 and above, current rates are really good for everybody else purchasing. We're seeing historic lows. Your higher tier credit people are seeing rates sub 3%. Average credit scores are in the 3 to 3.5% range currently. So, I mean, it's definitely helping the borrowers that are in a good position to borrow. It increases their buying power by having that lower rate. So obviously that leads us into the housing crunch that we're in now, where everybody's trying to buy before those rates go away. So flip side is we're getting kind of hammered with refinances. So people that are refinancing aren't selling, which is shortening the market on you guys. So one thing that as the market is getting tighter and competition is growing, one of the things we've been seeing, and I did want to cover for new agents and especially for you, Kristen, to kind of something for you guys to think about within your office. Obviously, with the competition, we have people putting in offers above and beyond list price. So be careful with that. What we're seeing is, you know, for example, somebody puts in an offer of $10,000 over list price, trying to secure, definitely make sure they get that, win that bid. And then we get to the appraisal and the appraisal comes in at list price. Now, you know, well, why was that appraisal cut? Well, it wasn't cut. It came in at what the home was listed for. Your client just went above that. So that's kind of becoming a problem, something to be aware of, that, you know, that gap will probably occur. Once that gap occurs, the seller's going to start cutting closing costs that they may have decided to give up in the beginning because they were accepting that extra money. Or, you know, it's becoming more problematic than what it should be. So kind of be aware of that when you're writing offers. May definitely want to put some language in there and make your buyers be aware that, you know, that's probably having a very good chance of happening. So that's kind of really all I have, unless anybody has more specific questions. Like I said, we're always here. I've got some flyers that Kristen has my email. I think Sherry has my email. I've got some more specific flyers on different programs that I can send out to anybody. And, you know, I'd be glad to talk to anybody one-on-one if, you know, anybody needs it.
Thank you so much.
Oh, you're welcome.
That was awesome. We have about 8 minutes. Does anybody have any questions for Jason?
No, but I'd like those flyers if you'll email them to me, Jason, of the different types of homeland or
yeah,
loans.
Definitely, Sherry.
Okay.
I actually have a program. I've got a couple of websites with some different marketing things that we offer to all of our agents. I'll get that out to you, Sherry. Anybody else who would like to email me, I can get you signed up. List Reports is one. It's a great tool for doing flyers on homes, open house flyers, things like that. We have another system that you, from within, you can print all of our marketing flyers, all of our program specific flyers, but I'll make sure I get that out to you specifically, Sherry, and anybody else who wants one, just drop me an email.
Yeah, I wrote everybody's names down that were on here so I can reach out to them individually or together and give them your information so they can reach out to you. Yeah, you guys, American Eagle is amazing. Very, very ethical company. A lot of our top agents in here use them. You know, feel free to use them as one of your preferred vendors for your clients. But just you know, be careful when you're giving preferred vendors. Give them a couple of lenders, maybe at least 2, 3. But definitely give them. Jason, do you actually? So you have your license, but
yes,
You are a lender.
I
as
am a
well.
loan officer. Feel free to contact me anytime for pre-approvals, any of that. You know, as I said, I'm kind of the I don't want to say utility guy, but I'm here to help your agents. So, you know, definitely I can, you know, shepherd them new agents through the process.
That's a good word, shepherd. And just a quick note, you guys don't have to know this stuff, right? We're not, that's why we're not licensed in loans.
Yep, that's exactly it. I was trying to make it as broad as possible without getting into specifics that are going to bore you to death. Just generally kind of know the difference, you know, that I guess kind of the biggest one, and aside from all of that, the biggest takeaway I will leave you with is, you know, sometimes you'll get maybe more experienced agents or agents that are trying to push the pre-approval amounts, or you know, kind of question, well, why is this FHA? Why can't we go conventional? This house, you know, this house won't go FHA. You know, there's a reason we do everything. You know, if we have somebody pre-approved at a certain amount, it's because there's a reason. If you know, if we said send an FHA pre-approval, it's because there's a reason. And you know, there's always, I mean, it doesn't hurt to ask, but generally, and I don't want this to sound mean, but you know, we stay in our lane with financing, and you know, realtors stay in their lane with housing. One of the biggest problems that we kind of run up against is, you know, you guys don't know this and don't need to know this. And then you have a client who comes to you as their advocate and says, well, you know, and starts asking financing questions. You know, we're not against the borrower. You know, we're all a team. The three of us are a team to get it done. You know, all financing questions should be addressed to us, obviously. So that's why you guys just kind of need to know the basics. And if you have any specific questions, you know, feel free to ask, but that's kind of what we do.
Yeah. So one of the things I used to do was I would basically say, like, you know, I have a couple of lenders, but you know, Jason from American Eagle, I work with. You can have a conversation with him. He's kind of like he's on my team.
Right.
So we work together, and
Exactly.
I push you through the paperwork, contract to close. He's going to push you through the finance, and you know, and it makes people think, ooh.
Yeah, exactly.
They have a team.
Yeah. And as far as new clients or borrowers, you know, I don't have a problem taking the time to explain and work with somebody to get their score qualifying, or get, you know, something taken care of so that they get to the point that they will qualify and you will be able to put them in a home. You know, it's not well, if you don't qualify, you know, you're out of here, call me when you do. We definitely want to work with the clients and make sure that we all, you know, get them through the process.
Any last questions? We have literally 2 minutes. It's going to cut us off. I wanted to keep this quick for you guys.
Is that it? Are we good?
Sandy, you unmuted.
I did.
You have a question?
I was just going to ask about and it's probably just a detail, that funding fee. Does everybody have that for the one type of loan?
For FHA, everybody will have a funding fee, and that gets rolled on top of the loan amount. So that's included in their final loan amount.
And is it the same for everybody? Or
Yes, for an FHA, it's 1.75% for all borrowers.
Okay, that's what I was wondering. Thank you.
Gotcha.
All right.
Excellent.
Well, thank you.
Oh, you're welcome, Kristen. Anytime anybody needs anything, I will, you know, I'm here. Feel free to give me a call, email. I'll get flyers out to everybody and my contact information. Seriously, anytime, no stupid questions. Feel free to give us